So you're seeing the stock market take a nosedive, and you might be wondering if it's time to panic. Maybe you've even considered selling everything. Trust me, I get it. This sudden drop has made a lot of people nervous. From stocks to crypto, everything's been sliding, and for those of you who are new to investing, this could be your first real test. You've probably started asking yourself, what's happening and should I be worried? Well, stick around because I'm going to break it all down for you. No fancy editing here, just straight up information to help you navigate this storm. Let's dive in. What's behind the stock market crash? To give you some context, the S&P 500 recently dropped 3% in a single day, which is the largest one-day decline in almost 2 years. The Dow fell 2.6%, while the Nasdaq slipped a staggering 3.4%. These are big numbers and they're understandably causing concern. But why is this happening? From my research, there are 4 main reasons behind this decline. Let's take them one by one and figure out if this is just another bump in the road or something more like the 2008 financial crisis. Reason #1. Fear of a recession. The first reason, and one that's hard to ignore, is the fear of an impending recession. Now, recessions are known to send stock markets tumbling, though there are exceptions. For example, during the 2020 recession, the S&P 500 actually returned a surprising 16.3% for the year. However, that's not typical. Normally, when a recession hits, spending drops. People stop buying as much, companies see their profits shrink, and eventually they start cutting jobs. This causes a vicious cycle. Less spending leads to fewer jobs, which leads to even less spending. The result? A drop in stock prices. Even though we're not officially in a recession right now, the market is reacting as if one might be on the horizon. The stock market often acts as a leading indicator, meaning it tends to react to what investors think is going to happen, not necessarily what's happening right now. So what's got everyone so spooked? Well, the job market isn't looking as strong as it should. Reports showed the U.S. added only 114,000 jobs in July, far below expectations of 150,000. And the unemployment rate ticked up to 4.3%, the highest it's been since late 2021. These numbers aren't catastrophic, but they've triggered something called the SOM rule, which essentially predicts a recession whenever the unemployment rate rises by 0.5% over its recent low. Historically, this rule has been spot on in predicting U.S. recessions since World War II. Now, to ease your mind, even Claudia Somm, the economist who developed this rule, thinks it might be wrong this time around. And Goldman Sachs, which increased its odds of a recession to 25%, also believes it's still unlikely. So why could the SOM rule be off? This time around, rising unemployment isn't due to people losing jobs. Instead, it's more about people entering the workforce. Meanwhile, we are seeing signs that people are spending less, and that's another key factor in predicting a recession. When companies like McDonald's and Walmart start reporting that their customers are tightening their belts, it's a red flag for the broader economy. Wayfair, a company I actually use quite a bit, has also reported a nearly 25% drop in spending from 3 years ago. Yes, all of this is concerning. But should you panic? Not necessarily. Even with the job market and spending slowing down, most economists and experts don't see this turning into a full-blown recession. There's also still time for the Federal Reserve to step in and take action to prevent the economy from sliding further. Reason #2. Interest rates. Now, let's talk about interest rates. Here's something interesting. Every time the Federal Reserve has cut interest rates from their peak, a recession has typically followed. And guess what? The Fed has hinted it might start cutting rates soon. But before you freak out, let's dig a little deeper. The key difference this time is why the Fed is considering cutting rates. Back in 2022, they raised interest rates to combat skyrocketing inflation brought on by the pandemic. Supply chains were in chaos, and inflation hit a peak of 9.1%. The Fed raised rates to cool things down, and it worked. Inflation has since dropped significantly, but it's still hovering just above their target rate of 2%. So now that inflation is mostly under control, they're ready to lower rates again. Not because they're trying to avoid a recession, but because they've done their job in controlling inflation. When interest rates are lowered, borrowing money becomes cheaper, which generally boosts the economy. This should be seen as a positive move for investors, unlike previous times when rate cuts were more of a last resort to stave off a recession. So while the Fed's actions may seem ominous, They're actually a good sign for the economy moving forward. Reason #3. Tech stocks. Now let's move to another big factor, tech stocks. If you've been investing in tech companies like Apple, Amazon, or Tesla, you've probably noticed that these stocks have taken a harder hit than most. And even if you haven't directly invested in them, it's still affecting you. Why? Because these Magnificent Seven tech companies make up around 31% of the S&P 500. So when they drop, the whole index fund feels the pain. Why are tech stocks struggling? A lot of it comes down to artificial intelligence. Over the last year or so, AI has become the new buzzword, pushing tech stocks to soar on the promise of revolutionary advancements. I remember attending a tech conference, and every other talk was about AI tools and how I should use them. I'm not going to lie, it got a little repetitive. The problem is that investors may have gotten too excited about AI, pushing stock prices higher than they should have been. Now reality is setting in, and those sky-high valuations are starting to come back down to earth. Even Warren Buffett's Berkshire Hathaway has cut its stake in Apple by almost 50%. Plus, there's been some bad news around AI development. For instance, Apple's AI tool didn't live up to expectations, and NVIDIA's highly anticipated Blackwell chips have been delayed. These delays are having ripple effects across companies like Meta and Microsoft, creating more volatility. To put it simply, I think the market got a little ahead of itself with AI. It reminds me of the dot-com bubble in the late 1990s when tech stocks soared, only to crash hard. Just remember, the stocks that rise the fastest often fall the hardest. Reason #4, the Japanese yen. This last one might come as a bit of a surprise, the Japanese yen. Now you might be asking, what does Japan have to do with all this? Well, let me explain. For years, traders have been taking advantage of a clever loophole. They'd borrow money in yen because Japan had almost zero interest rates, invest that money elsewhere, and then repay the loan when the yen's value dropped. It was a pretty sweet deal. But everything changed when the Bank of Japan raised interest rates for the first time in a while. This move caused the yen to strengthen, which was bad news for traders using that loophole. They suddenly had to sell off their investments to cover their losses. Some experts believe this mass selling is part of why the stock market is struggling right now. Fortunately, the Bank of Japan has since eased up on interest rates, which has helped calm some nerves. But it goes to show that global events, even ones that seem far removed, can have a significant impact on your investments. So, what does all of this mean for you? How should you navigate these choppy waters? First, let me say that I'm not a financial advisor, but I've been in the investing game for a long time. Here's what's worked for me. The best advice I can give is to buy when there's blood in the water. In other words, when everyone else is panic selling and stock prices drop to irrational levels, that's when you should consider buying. You've probably heard the phrase, buy the dip, and it holds true. But before you do that, make sure you have an emergency fund in place. I recommend having at least 3 to 5 months of living expenses saved up, just in case things get worse before they get better. No one can predict exactly what's going to happen next. The market might keep going down, or it could rebound. The key is to dollar cost average into the market, especially when prices are low. This means investing small amounts consistently over time, whether it's weekly or monthly. If you're new to investing and have been waiting for the perfect time to start, this could be a great entry point. Just remember, there are no guarantees, but getting in at a lower price is better than waiting for the market to climb back up. Another thing to keep in mind is diversification. Spread your money across different types of assets, stocks, bonds, even crypto if you're into that. This helps you reduce risk. If one investment tanks, the others can help cushion the blow. For those of you who, like me, prefer index funds, you're already diversified. But it might be worth looking into a total U.S. stock market fund to broaden your exposure beyond just tech-heavy indices like the S&P 500. Lastly, keep your eye on the long game. It's easy to get swept up in the daily noise of the stock market, but remember, investing is a marathon, not a sprint. There will always be ups and downs. If you can stomach the current volatility, you'll likely come out on top in the long run. To wrap it all up, yes, the stock market is down, and yes, things look shaky right now, but this is far from the end of the world. Whether it's fear of a recession, falling tech stocks, or even something as obscure as the Japanese yen, the market will recover. It always does. And for those of you who have been playing the long game, A market dip like this is a great opportunity to pick up some bargains. Just remember to keep your investments diversified, stay patient, and above all, don't panic. You've got this.